Most people hear the word cryptocurrencies and immediately think of Bitcoin shooting up, crashing down, or someone becoming rich. But the truth is that crypto is much more than fast price swings. At its core, cryptocurrencies are simply digital money, governed not by banks, but by blockchain technology. And once you understand the idea behind it, the entire system becomes much easier to follow. So let's start from the beginning. Imagine sending money to someone across the world. Normally, you need a bank, a fee, waiting time, and a whole chain of intermediaries. But what if you could send that money instantly at any hour of the day with no bank involved? That's the idea behind cryptocurrencies. Crypto runs on blockchain, which you can think of as a giant public notebook, open to everyone, impossible to erase, and constantly updated. Every time someone sends or receives a cryptocurrency, it gets recorded on that notebook in a way that can't be changed. That's what gives crypto trust. Not a bank, not a government, but a transparent system. The most well-known cryptocurrency is Bitcoin, created in 2009 by the mysterious Satoshi Nakamoto. The idea was simple: create a digital form of cash that no one can control, freeze, or manipulate. Bitcoin became the first decentralized currency in the world. Since then, thousands of other cryptocurrencies have emerged, each with different purpose. Some cryptos act like digital money, some power applications, some represent ownership, and others are used for staking, governance, or security networks. In a way, cryptocurrencies are like apps in an app store. Each one does something different. Let's talk about Ethereum, the second largest cryptocurrency. While Bitcoin is like digital gold, Ethereum is like a global computer. Developers can build apps on it, financial apps, games, NFTs, and marketplaces. These apps run off something called smart contracts, which are programs that execute automatically without needing of a middleman. One of the most attractive things about cryptocurrencies is accessibility. Anyone with internet can participate. Wherever they live in New York or Nairobi, they can use cryptocurrencies. You don't need a bank account. You don't need permission. All you need is a digital wallet. So what moves cryptocurrency prices? A lot of the same things that move forex or stocks: supply and demand, economic news, global sentiment. But crypto also reacts to technology upgrades, regulation, adoption, partnerships, and even social media. Because the market is young and fast-moving, prices react quickly. Cryptocurrencies are also highly volatile. That means they move fast, not just up but down too. In traditional markets, a 3% move in a day is big. In crypto, a 3% move can happen in minutes. This volatility creates opportunity, but it also requires discipline. Without risk management, traders can lose money just as quickly as they make it. Another key part of crypto is decentralization, meaning no single authority controls it. Money today is centralized. The bank controls your transfers, governments control your currency, and platforms control your accounts. Crypto flips that model. If you hold your crypto in a private wallet, you, not a bank, own your funds. No one can freeze them or take them, but decentralization has two sides. Without banks or intermediaries, you gain freedom, but also responsibility. If you lose your password or send money to the wrong address, there's no customer service to call. In crypto, you're the bank. Crypto has also created entire financial ecosystems known as DeFi, decentralized finance. In DeFi, you can lend, borrow, earn interest, and trade without banks. Everything runs through smart contracts. Then there are NFTs, digital collectibles stored on the blockchain. They're not just images, they can represent ownership of art, music, game items, event tickets, even real estate. Now, how do people trade cryptocurrencies? Many use crypto exchanges like Binance, Coinbase, Kraken, or Bybit. These platforms let you buy and sell coins just like stocks or forex. Others trade directly on decentralized exchanges where no companies control the platform. Crypto markets operate 24 hours a day, 7 days a week. There is no closing bell. This constant activity makes the market very dynamic but also demands emotional control from traders. Just like in forex, traders use technical analysis, structure, liquidity displacement, and smart money concepts to navigate crypto charts. The pattern repeats because human psychology repeats. Even though crypto is newer, price still respects liquidity zones, imbalances, fair value gaps, and institutional footprints. But what really separates crypto from other markets is adoption. Every year, more companies, banks, and governments integrate blockchain technology, sometimes even creating their own digital currencies, known as CBDCs. Every year, more companies, banks, and governments integrate blockchain technology, sometimes even creating their own digital currencies. So what's the main takeaway? Cryptocurrencies are not a trend, they are an evolution. They are changing how we think about money, ownership, identity, and technology. But like any new technology, they require education. Understanding what you're trading is the foundation of making good decisions. Crypto isn't about gambling or the next Bitcoin. It's about understanding how digital money works, how blockchain creates transparency, and how decentralized systems gives people more control. Once you understand those principles, the volatility becomes less intimidating and the opportunities become clear.